Hey guys, Rafi here from the Endgame Investor, and the IMF is scared out of its mind for what is going to happen to the banking system. They have released a concluding statement for Article 4, something or other, that shows that they are actually very worried about what is coming down the pike for the financial system in tones that are much more negative than they were in 2007 or even on June 2008 on the eve of the great financial crisis. When the IMF is worried, you should be worried too, or not worried, depending on whether you have real money or not. But if the elite of the elite criminal banksters are worried about what is coming, it's a good indicator that something wicked this way comes, at least for them, if not for us, as long as we are sufficiently protected with rational decision making. So let's begin with the 2023 statement of something or other that I don't remember, but I'll read it when I see it right now. United States of America, staff concluding statement of the 2023 Article 4 mission. This is the most important mission of all the articles. And of all the articles that they have, Article 4 is like a really big one or something. I don't really know what it means, nor do I care, but this is like good comedy, so I'll cover it now. The U.S. economy has proven resilient in the face of significant tightening of both fiscal and monetary policy that took place in 2022. Let's take a look at that sentence, shall we? Monetary tightening. We have here the money supply from 2013 to today, a 10-year chart of the money supply in the United States of America. And here I drew a trend line, this black little line, right? This is the trend line where we would be had we been on the same general monetary policy from 2013 to 2020. Continue that trend line out to here results in something along the lines of $17.5 trillion. This is billions of dollars over here. We're at somewhere between 16 and 18. I'm estimating 17.5 trillion, give or take a few $100 billion. What's $100 billion between friends? It's not much when you're talking about big globalist money printing organizations. And we are now at a money supply of $20.6266 trillion. Yes, granted, we have tightened in quotation marks from 2022 when we were at about $22 trillion. And yes, that is significant tightening relative to the insane printing that we had done from 2020 and 2021. Now we're on our way down. Yes, this is tightening. And yeah, it is significant tightening, but why is the U.S. economy so resilient in these terms, or at least in relative terms? Well, we're still about $3 trillion more than we would have been had we conducted the same monetary policy that we had conducted. Who am I saying we? The Fed, whatever. The money printers. If they had conducted the same monetary policy that they were conducting from 2013 until 2020. So there's still a lot of overhang there, about $3 trillion of monetary overhang. So it's not surprising that things haven't exactly collapsed yet. But, oh, believe me, they're on their way. Let's continue with the international monetary fraud. Rising wages for lower income workers, rapid unemployment growth, and pandemic-related government transfers made important inroads into reducing poverty in 2021. Yeah, when you transfer trillions of dollars to lower middle-class people, it'll make them less poor. That's true. Most notably, the share of the population living in poverty fell markedly from 11.8% in 2019 to 7.8% in 2021. Yeah, after the hell of 2020 and locking them all in their houses, but yeah, that's just a minor point. The poverty rate for Black and Hispanic households fell by almost twice as much as the national average. Close to half of this improvement, that's Freudian. Close to half of this improvement came from fewer children living in poverty. This is great. I love these parentheses. Mostly due to the economic impact payments and the fully refundable child tax credit. What does that mean? The economic impact payment? Well, we gave these people a bunch of money for doing nothing in 2020 and 2021 because we didn't allow them to do anything because we were on lockdown. So we gave them money, and now, oh, look at that. They're richer. This is amazing. We should keep doing this. Unfortunately, says the IMF, these impressive gains in tackling poverty appear to have been largely unwound in 2022 as pandemic benefits expired. And then skipping down to here, this creates a material risk that the Federal Reserve will have to raise the policy rate by significantly more than is currently expected to return inflation to 2%. This is the key sentence here that shows that they are actually worried that something serious could be brewing here. The longer that higher interest rates persist, the greater the likelihood that such fractures will be revealed in the Treasury market it's talking about. Recent failures of large non-internationally active banks, which have so far only had a modest effect on credit conditions, could potentially be a prelude to more serious and ingrained systemic financial stability problems. So what was the IMF saying in 2007 on the eve of the financial crisis? They were much more positive back then than they are now in this little missive of Article 4 in 2023. Here we go, 2007, June 22nd, 2007, Article 4, Consultation with the United States of America, concluding statement of the IMF mission. We share the U.S. authorities' view that the most likely scenario is a soft landing as growth recovers and inflation falls, although both are subject to risks. Activity should pick up as the drag from housing dissipates, business investment recovers, and higher foreign growth supports net exports. This yields a baseline of 2% annual GDP growth in 2007, rising to 2.75% in 2008. Current monetary policy settings are consistent with the soft landing. In conclusion, says the IMF in 2007, the U.S. economy continues to show remarkable dynamism.
The Slim Lazy Homer you knew is dead. Now I'm a big fat dynamo.
Let's see what they were saying in July 2008, right before everything collapsed. The slowdown in activity in the United States has been less than feared. Ooh, that's great. And recovery should begin next year as important headwinds are overcome. Well, they were right about the recovery, but they weren't right about the slowdown being less than feared. Yeah, not so much. As such, we project that real GDP for Q4 2008 will be roughly flat in 2008 and recover gradually in 2009 to around 2%. Well, we know the actual recession was much more severe than that. And here's their conclusion for June 2008. Conclusion, U.S. authorities are to be congratulated. Congratulated.
You did it! Congratulations! Great job, everybody. It's great to meet you. Hi.
On their rapid and innovative responses to a complex crisis, which basically included printing a whole bunch of money. And now, where was the IMF in 2009 after they realized that they'd screwed everything up? Let's take a look. 2009, Article 4, Consultation with the United States of America, including statement of the IMF mission. First, a mea culpa by the IMF. The U.S. financial and economic crisis has had severe global repercussions. The run-up to the crisis involved a substantial and widespread underestimation of risks. The sharp decline in housing prices that started in 2007, which we said would be fine and not a problem, weakened several systemically important financial institutions, culminating in the collapse of Lehman Brothers and revealing major weaknesses in the U.S. regulatory and resolution frameworks. This was followed by the worst global financial panic since the Great Depression, with extreme strains in a broad range of markets, volatility in capital flows and exchange rates, and a cascade of systemic events.
And the truth shall set you free!
And so we see here, relative to the mea culpa of 2009, the 2007 and 2008 Article 4 conclusion whatevers were pretty positive, rose-colored, and uppity compared to the one for 2023, which has a lot of worrying tones in it about banking crises. The IMF knows that something big is coming, and they are worried, particularly about Treasury market functionality. And we have a tentative debt ceiling deal, which will probably be passed this week. And following that, we will have about $1 trillion of Treasury bills dumped on the market in short order, which should suck out $1 trillion more in deposits from the banking system, and that could bring money supply back down to where it would be had the COVID printing never happened. All this is going to lead to a stunning reversal by the Federal Reserve, which will cut rates right back down to zero or possibly even nominally negative, depending on how bad the crisis gets. And from there, we will see the final death of the dollar, along with all fiat currencies that are currently based on the dollar through the skeletal remaining structure of the Bretton Woods system that ended in 1971. But the scaffolding of that system still exists, and that scaffolding is what has to fall for gold and silver to take their rightful place as money directly once again and end the inflationary nightmare. Inflationary in so many aspects, not just monetary, but academically, medically, and all the other aspects of society that are clearly poisoned these days. It is all coming to a glorious, spectacular, and hyper-inflationary end. And if the IMF is worried about it, that's good news. This is Rafi with the Endgame Investor. If you enjoyed this video, then subscribe to a 2-week free trial of the Endgame Investor, where I give you a front row seat to the endgame as it unfolds on a daily basis. Or you can become my patron on Patreon, where I give a weekly biblical commentary on monetary and economic policy topics. And of course, you can support this channel by buying your gold and silver, your physical gold and silver with Miles Franklin, by calling 855-GAME-END. And I'll see you guys in a few days. And thank you, IMF, for being so brutally honest.